So you've started earning, and you're hearing all this talk about investing. Where do you even begin? Well, you're in exactly the right place. Today, we're going to pull back the curtain on the stock market with a super simple, no-bluff guide that'll help you take those first big steps on your financial journey. Let's dive right in. I mean, it's the biggest question, isn't it? You see those crazy charts on the news, those green and red lines jumping all over the place, and it just looks like chaos. But what if I told you that all that drama, all that movement, really just boils down to one very simple, very human idea? We're going to unravel that mystery right now. Okay, first up, the market's heartbeat. In this first part, we're getting right to the core of it. We're going to understand the one fundamental reason why prices move at all. First things first, what even is a stock? It's not just a number on a screen. When you buy a share of a company, you are literally buying a tiny, tiny piece of that business. You become a part owner. So when that company does well, the value of your little piece can go up. Simple as that. Now here's the secret. The stock market is basically just a giant auction. Think about it like trying to get tickets for a huge concert. If there are only a few thousand tickets, that's the supply. But 100,000 people want to go, that's the demand. What happens to the price? It goes through the roof, right? The stock market works on that exact same principle. What you're looking at here is the market's constant tug of war. On one side, you've got all the people who want to buy a stock. If there are more buyers than sellers, they start outbidding each other, and the price gets pushed up. On the other side, you've got people trying to sell. If there are more sellers than buyers, they have to drop their prices to attract someone. This little battle happens millions of times a second, and that is the heartbeat of the market. All right, part 2, your investing philosophy. So we get why prices move. But with literally thousands of companies out there, how on earth do you decide what to buy? Let's get into the mindset you'll need. Look, for most of us, the goal here isn't to get rich overnight. It's about building wealth slowly, steadily, over time. And that's the whole idea behind long-term investing. You find good companies, you hold on to them for years, maybe even decades, and you let them grow, riding out all the little bumps along the way. It's a marathon, not a sprint. So the big question is, how do you actually choose those companies? I mean, if you're going to put your hard-earned money into a business for the next 10 or 20 years, you need a way to figure out if it's a good bet. This is where investors kind of put on their detective hats, and there are two main ways they investigate. On one hand, you have fundamental analysis. Think of this like being a business detective. You're digging into the company's health, its profits, its debts, who's running the show. You're trying to figure out if it's a solid, healthy business. Then on the other hand, you've got technical analysis. This is more like being a chart reader. You're not looking at the business itself, you're looking at the stock's price history, searching for patterns to predict where the price might be headed next. Okay, part 3, your starter investing kit. Now, picking individual stocks can be really time-consuming and honestly, pretty risky for a beginner. So in this section, let's meet your two new best friends, mutual funds and ETFs. Just think about it for a second. If you put all your savings into just one company, and that company gets into trouble, well, you could lose a lot. But what if you could take that same money and spread it across 50 or even 500 different companies all at once? That is the magic of diversification, and it's probably the most important way to reduce your risk when you're starting out. And that's exactly what mutual funds and ETFs, which stands for exchange-traded funds, do. They are basically pre-packaged baskets of investments. You put your money in, and a professional manager instantly spreads it across tons of different stocks or other assets for you. They're slightly different in how they trade, but for a beginner, the big idea is the same. They give you instant diversification. Part 4, how to read the label. Okay, this is where our no-bluff guide gets really practical. Just like reading a nutrition label on food, you absolutely need to know what you're looking at before you put your money into a fund. So not all funds are built the same. Before you invest a single penny, you need to check these 4 things. Think of it like your pre-flight checklist. And pay really close attention to these first 2 we're about to talk about, because they have the biggest, most direct impact on how much money you actually end up with. First up, and this is a big one, direct versus regular plans. A regular plan means you're buying through a middleman, like a broker who takes a commission. A direct plan means you go straight to the source. It's the exact same fund, but the direct plan has lower fees, which means more of your money is actually working for you. The no-bluff advice here is simple. Always, always go for the direct plan. Next up is the expense ratio. This is the small annual fee the fund charges to manage everything. Now, it might look tiny, like the difference between a 1% fee and a 0.5% fee. But trust me,
Over time, this is huge. That tiny 0.5% difference could cost you lakhs in lost profits over 20 years. Your goal here is crystal clear. Find the lowest fee possible.
Then you've got the exit load. This is basically a penalty fee if you try to sell your investment too early, usually within the first year or so. Look, life happens, and if you suddenly need your money back, the last thing you want is to get hit with the surprise penalty. So always look for funds that have zero or at least a very low exit load. And finally, check the fund manager's stability. Think of the manager as the captain of your investment ship. Has the captain been at the helm for a long time? Have they steered the ship through both calm and stormy seas? A consistent, experienced team is often a really good sign of a stable, well-thought-out strategy.
Okay, Section 5. Investing beyond companies. Now that you know about these handy tools like ETFs and mutual funds, it's cool to realize they're not just for buying pieces of companies. Let's take a quick look.
For instance, you can use an ETF to invest in things like gold or silver. This lets you own a piece of these precious metals without, having to actually buy gold bars and find a safe place to store them. You can also use funds to invest in things like government bonds. It's just another great way to spread out your risk beyond just the stock market. All right, our final section, your next lesson. Wow, we have covered a ton of ground today, from the basic heartbeat of the market all the way to a practical checklist for your very first investment. Let's put a bow on this. I absolutely love this proverb because it is so, so true when it comes to investing. It is so easy to think, I should have started years ago, but you can't change the past. The single most powerful thing you can do for your financial future is just to start today with whatever you have.
And that was really our goal today, to give you that solid foundation. You now understand the why of the market, supply and demand. You get the how, thinking long term, and you know the what, powerful tools like mutual funds and ETFs that can help you get started safely.
But this brings us to the final and maybe most important question. Knowing what to look for on the label is one thing, but with literally thousands of funds to choose from, how in the world do you find the one that's perfect for your goals, your age, and your comfort level with risk? Well, that is exactly what we are going to break down, step by step, in our next explainer. I'll see you then.